Apple just reported fiscal Q2 earnings, and the numbers were stronger than the AI bear narrative suggested. Revenue came in at $111.2 billion. Earnings per share came in at $2.01. Gross margin hit 49.3%. Services reached about $31 billion, and Apple authorized another $100 billion in buybacks. So this was not a weak quarter. But the market is not just asking whether Apple is profitable. The real question is whether Apple can turn its ecosystem into a real AI growth engine. This is the Apex Wealth AI breakdown of Apple's fiscal Q2 earnings. We are going to look at the headline numbers, why the quarter was stronger than the bearish narrative suggested, why services remains the margin engine, what the $100 billion buyback really means, and why WWDC may now be the most important catalyst for Apple's AI story. The bottom line is simple. Apple proved the operating machine is still elite. Now investors need proof that the AI story is real. The biggest mistake investors can make with Apple right now is assuming that because the AI story is still unclear, the core business is weak. That is not what this quarter showed. The iPhone business remained resilient. Services kept compounding. Margins were strong. China improved. And Apple's guidance for the next quarter came in better than expected, with revenue growth expected in the 14 to 17% range. The question is not whether the machine works. The machine works. The question is whether the next growth lane is big enough to justify a stronger valuation narrative. Let's start with the scoreboard. Apple reported $111.184 billion of revenue, which will round to $111.2 billion. EPS came in at $2.01. Net income was $29.6 billion. Gross margin came in at 49.3%. Services revenue reached $30.976 billion, or about $31 billion. Products revenue was $80.208 billion. And iPhone revenue was roughly $57 billion. That is the key point. Apple is still generating massive scale, massive profit, and extremely high margins. This quarter reminded investors that Apple is still one of the strongest operating businesses in the world. The iPhone remains the core revenue engine. Services is the high-margin layer that sits on top of the installed base. China improved, which helped ease one of the biggest concerns around the stock. And guidance came in stronger than expected. In dealership terms, Apple still has the best showroom, the most profitable service lane, and a customer base that keeps coming back. That is why Apple is so hard to bet against. The machine is not broken. Services remains one of the most important parts of Apple's investment case. At about $31 billion this quarter, services is the recurring high-margin layer sitting on top of Apple's installed base. This is the part of Apple that behaves less like a hardware cycle and more like a toll road. App Store, subscriptions, iCloud, payments, AppleCare, media, licensing. Every additional device strengthens the services ecosystem. That is why investors care so much about services growth. It helps smooth out hardware cycles, supports margins, and increases the value of each customer relationship over time. Apple also authorized another $100 billion in buybacks and raised the dividend to 27 cents per share. That matters because Apple's capital return program is one of the strongest in the market. Buybacks do not fix a weak business. But when a company is already this profitable, buybacks can support EPS growth, reduce share count over time, and return excess cash to shareholders. For investors, this reinforces Apple's role as a premium cash flow compounder. The trade-off is that buybacks are not the same thing as a new growth engine. They support the investment case. They do not replace innovation. Now we get to the real issue. Apple's quarter was strong, but it did not fully solve the AI question. Microsoft is monetizing AI through enterprise software and cloud. Google is pushing AI through search, cloud, models, and infrastructure. Meta is building AI into advertising, engagement, and recommendation systems. Amazon is tying AI to AWS, commerce, and logistics. Apple's AI opportunity is different. Apple has the device layer. It has the operating system layer. It has the privacy angle. It has custom silicon. It has the installed base. And it has the ecosystem control. But investors still want proof that Apple Intelligence, Siri improvements, on-device AI, and developer tools can become real growth drivers. Right now, Apple's AI story is more potential than proven monetization. That is why WWDC matters so much. Here's the risk-reward setup. The reward case is clear. Apple still has elite profitability. Services keeps growing. The installed base remains extremely valuable. The buyback is massive. The brand is durable. And if Apple shows credible AI progress at WWDC, the stock could earn a stronger narrative. But the risk case is also real. Apple is not getting the same AI multiple expansion as Microsoft, Google, Meta, or Amazon. Memory and component costs could pressure margins. Supply constraints could limit upside. China remains a geopolitical and competitive risk. And if WWDC feels incremental instead of transformative, investors may keep treating Apple as an elite cash flow compounder, but not a leading AI growth story. So what should investors take away? Apple is not broken. This quarter showed that very clearly. The operating business remains one of the strongest in the world, but Apple is also not getting the same AI credit as the other mega-cap tech names. That creates a very specific setup. If you own Apple, the quarter supports the durability case. If you are looking to buy Apple, the question is whether you are buying a premium cash flow compounder, or whether you believe the AI story is about to accelerate. Those are two different investment theses. Durability is already visible. The AI upside still needs proof. Bottom line, Apple proved the operating machine is still elite. But the next leg of the story depends on whether Apple can turn AI from a feature set into a growth engine. That makes WWDC the next major catalyst. Follow Apex Wealth AI for market intelligence without the noise.